The ultimate 10 stocks under $25 tier list. What is happening, investors? It is your boy Jack. I am not a financial advisor. I got the hoodie to prove it. And today we're going to be having a look at 10 companies whose stock price is currently below $25. If you haven't seen one of these videos before, I've done a few now, and essentially we're going to rank these companies from super amazing all the way down to stay away. And this has been requested a few times to, look at some cheaper stocks for, people who don't have fractional shares. So that is exactly what we're going to be doing today, people. I have 10 companies who are all quite well known or else exciting for one reason or another that we're going to speak about today. In these videos, we go through each company very briefly because obviously there is 10 companies. We're not going to spend all day on them, but I'm not going to waste any of your time. We are going to get straight into this video. Right before we do, can I please ask you to smash a like on this video? I mean, this is the second upload of the day. We ain't slowing down out here, baby. The road to 20,000 is on, and I'm going to make sure we get there quickly. With that being said, if you're new around here, please hit that juicy red subscribe button. It would mean an awful lot to me. Join the family. And lastly, once you've watched this video till the end, feel free to drop me a comment down below. Let me know what you would change. If there's any you'd put a bit higher, a bit lower, whatever it is. But anyway, guys, let's get straight into the 10 companies for today. So these aren't going to be done in any particular order. It is all random. And in front of you, you will see we have super amazing, amazing, quite good, mid-tier, meh, and stay away. The 10 companies we're going to be having a look at. Okay, we have American Airlines, Carnival Cruise Corp, Dave & Buster's, EPD, Enterprise Product Partners, MGM Resorts, NIO, Norwegian Cruise Lines, Upwork, Virgin Galactic, ticker symbol SPCE, and Workhorse. So let's not waste any time. Very first company of today, we have American Airlines. Now, American Airlines has been on a crazy journey this last while. Okay, so when the crash started to happen, these guys fell down as much as pretty much 70% in value. Now, from those lows, we actually went on a run. We went on a massive run up 115%. And the large majority of this literally happened in the span of 2 or 3 days. We were up 71% in 3 days. Now again, since then they have given back an awful lot of that value to the extent of 43.5%. And this is actually despite the fact that the TSA checkpoint travel numbers have been going up and up consistently. If we just look here, around the start of June is when it really took off, and around the start of June there was about, let's say, 300 to 350,000 people going through these checkpoints every day. Now we're up to pretty much 600 to 700,000 people a day, so quite literally double the amount of people flying, and the stock price has come down an awful lot. Now, I was a big bull on airlines, and I still am in the very long term, but American Airlines is actually one of my least favorite if I was going to invest. If I wanted an airline that would give me an awful lot of return, I would be looking to Delta Airlines, and if I wanted a safer play, I would look towards Southwest Airlines. American just has the worst balance sheet pretty much of everybody. So because of the fact they have such a bad balance sheet, and the world of travel is so uncertain going forwards, and I just think there is much better options, I'm going to put them all the way down in meh. You know what I mean? I could nearly put them in stay away, but there is some good long-term potential there if you're willing to hold on to them through the volatility and if they ultimately don't have to file bankruptcy. Okay, Carnival Cruise Corp. An interesting one. It's important to understand as well, guys, I'm going to be ranking these purely as companies under $25. So I'm not going to be ranking them, compared to the best companies in the world, the big massive companies, the Facebooks, the Googles, the Amazons. That wouldn't really be fair. So if a company gets a higher or lower rating on this video than it would in another video, that's just the reason why. Another company who has had a crazy run both up and down has been slowly but steadily going down despite some potentially positive signs in the future. 6-month chart as of right now, still down 70%. That is absolutely horrific. Their market cap now is below $11 billion. Nikola, a company who exists pretty much purely off hype and a concept, has a market cap of nearly $14 billion. That just goes to show how small this has gotten, and it's for good reason. It is such an uncertain industry. Nobody knows where this industry is going to be in the next year or two. We really don't. And the thing is, even before this virus hit, there was a solid 2 years where slowly but surely the stock price was coming down, and from there it's down nearly 80%. So even before the virus hit, it wasn't performing particularly well. Now, I do in the long term see quite a bit of upside for this company, potentially, but it could be a very long time, and I think investing in a company like Carnival Corp, your money's going to be tied up for a considerable period of time. I just think there's way better places to put that money. So it is a company that, again, I personally wouldn't invest in right now. I just think your money would be tied up for too long for not enough potential gains. I'm going to put them with American Airlines into meh. Okay, Dave & Buster's. 6-month chart, down over 70%. They're an American restaurant and entertainment business headquartered in Dallas. They have 137 locations. Even I know who Dave & Buster's are, and I'm not in the US. I've never been to one, I don't know if they're good, but I know the name. On the 5-year chart, down nearly 70%. The 5-year chart has shown some big up moves, big down moves. They've been volatile in nature altogether. But even before this crash, on the 5-year chart, this company was only up about 20%. Hedge funds have never been less bullish on Dave & Buster's Entertainment. Essentially, more and more hedge funds are actually selling out of whatever positions they had in Dave & Buster's. Now look, I've looked into these guys a little bit in the past. I've seen some of the bull thesis. I see a lot of the bear thesis. When we look at the balance sheet, it doesn't look horrific. Okay, where are we? Current assets, 229 million. Total assets, 2.56 billion. Now keep in mind, the large majority of this is their property, plant and equipment. Okay. Current liabilities, 360 million, so considerably higher than the assets. And total liabilities, 2.37 billion. But again, most of that is in regards to their capital leases. I don't see a fast recovery here. Again, I don't see why I would want to invest in this company. Market cap's less than $1 billion. Maybe there's some sort of really long-term play to be done here, but it has been downtrending for a considerable period of time. Since going public, they're down 26.85%. I think there are far better places to be willing to take a risk. Me personally, I don't see any reason to invest in this company. I'm actually going to put them into stay away. Okay, Enterprise Products Partners. Now this is a very interesting one. It's a company they have a dividend yield of nearly 10%. On the 6-month chart, they're currently down 36.5%, so still down a very considerable amount. Now me personally, it's a company I like. I do understand it's in a struggling industry. I understand that it's not going to be a particularly quick recovery, but long term, I do really like the look of this company. If you're not aware of what they are, they're an American midstream natural gas and crude oil pipeline company. So they're in midstream utilities. Now again, with this one, the 5-year chart, very sideways, not a lot happened, but do keep in mind it is a 10% dividend yield. It's a massive dividend yield. The last time we came out of a tough economic time, okay, the Great Recession, they absolutely boomed up in value in the preceding years. Then there was some political issues in regards to pipelines, and since then it's just been steady. If they didn't have a big dividend yield, I wouldn't be anywhere near as inclined to pick up this company, in all honesty. But I do see a very realistic upside of over $25-26 in the relatively short term, which is not a bad return by any means whatsoever. I mean, 50% on a company with a 10% dividend yield in a short period of time is very attractive. Now, it is in a very risky sector right now. The future of the sector as a whole is quite uncertain. So for me personally, I do like them. I do own a small position in them. I'm not really inclined to add to my position right now. I think there are much better places to put your money, but I would throw them into quite good. That dividend yield itself, very good for a dividend investor. And as well, they do have a 21-year dividend streak, so it's not exactly particularly new. And they also only have a payout ratio of 60, which is very low for an MLP. Right, next up we have MGM Resorts. This one definitely has been on a crazy ride, okay? 6-month chart, we're still down pretty much 50%. They were down as much as nearly 80%. They then went on an incredible run. I mean incredible, 232%. Since then though, yet again, they've given back 31% of that value. You all probably know who these guys are, MGM Resorts. They're an international American global hospitality and entertainment company operating destination resorts in Las Vegas, Detroit, Mississippi, Maryland. Most people will think of Las Vegas when we think of MGM. The casinos, the big hotels, etc. Very, very struggling industry right now. For once, we're looking at a 5-year chart that actually had quite nice growth, okay? We were looking at 90% before the crash. Now, on the Max stock chart, you can see what happens to this company in economically tough times. They lost nearly all of their value during the Great Recession. Now, since then, it was most certainly, undeniably, an astounding run up, okay? Pretty much 1,000% since coming out of the Great Recession. It's a very volatile company. It's a very high-risk company, and I don't think you're going to see a lot of returns until the world is back to normal, and until a lot of people have a lot of discretionary spending money available to them once again. Right now, I'd put them into stay away. But the thing is, I could see a company like this having incredible long-term prospects. So for that reason, I put them into May, with the understanding that someday they could easily go up to quite good or even amazing if the economies are to get a lot better. Now, next up, we have NIO, an EV stock, something everybody's going to be excited about. Now, NIO isn't one of my personal favorite EV companies. I do understand the bull thesis for them. It's another one of the very, very volatile EV companies. I mean, it can go up 100%, they can lose 25%. The snap of a fingers, pretty much anything can happen with a company like this. Now, look, I love electric vehicles. I love the prospects that EV has going forwards into the future as a very long-term investment. I think that they could be absolutely incredible. In regards to EV though, I do think that there are better opportunities out there that do potentially carry a little bit less risk. For me personally, I'm going to put NIO into quite good. I definitely think it's a considerably better investment than these. A little bit safer. It is very volatile in nature. I mean, if we only go back to a couple of months ago, this was a $2-3 stock. It went up as high as pretty much $15 and is currently sitting pre-market at $13.50. So yeah, you definitely need some strong hands to be involved in this company, but I could see a world where NIO blows up in China and makes an awful lot of money. I know you could make an argument for amazing, some people would even make an argument for super amazing. For me personally, they're going into quite good. Okay, we have Norwegian Cruise Line. I don't have an awful lot to say about these guys that I didn't say about Carnival. What I would say is I think they're a slightly worse investment than Carnival, just because Carnival, they were the bigger company by far. They had more market share, they had more ships, they had more room to grow. So look, I'm not going to get into it, but I'm going to throw them into meh as well. It wouldn't be fair to put them into stay away. We have 3 more companies, and these are probably 3 of the most exciting companies. So first up, we have Upwork. I did speak about these guys quite a while ago, probably a few weeks, maybe even more than a month ago. Now this is a company I've kept up to date with. Unfortunately, they're not actually available on my broker on Trading 212, so if I did want to invest, as of right now, I couldn't. But I've kept up to date with them nonetheless. If you don't know who Upwork are, you're more than likely aware of who Fiverr is, and they offer very similar services. In-demand talent on demand. Say, for example, you want to hire somebody to edit your YouTube videos. You could go on to Upwork and find someone to do that. Video editor. There are loads of different editors. It shows you their price per hour, how much they've made altogether, where they're based, the customer feedback, a little description of them all, what they specialize in, things like that. So that's what Upwork are in essence, and they're up and coming. They've gained a lot of popularity as of late. And if we go through the broader timescale, okay, when they went IPO, we were at $21 a share. You know, what we see a lot of the time, we had an initial dip, they came back up, and then they really proceeded to go on a dip. I mean, a massive dip, okay? They fell down as low as $5.40 a share on the 3rd of April, okay? Now, since then, it's been a fantastic recovery, up 172% in such a short time span. Now, in this world, I see more and more demand for companies like Upwork and Fiverr going forward. And if Upwork can, you know, get their name out there just a little bit more, make more people aware that they are out there, I think they're going to do absolutely fantastic. Current assets 312 million, total assets 482 million, current liabilities 185, and total liabilities 222. So all in all, very good position balance sheet wise. The growth has been absolutely fantastic. It really has been. But also, they just don't have the history yet for me to be very confident as a long-term investor. I really would like to see a little bit more from them before I was confident enough to invest. And I know you make the big money investing in a company before they get big. I just need to see a little bit more from this company. With that being said, for the time being, I still would have to put them up into quite good. I mean, I feel considerably safer investing my money into these than pretty much any of the other companies we've gone through today, in all honesty. But now, we have the 2 most exciting companies. First up, Virgin Galactic, SPCE. I uploaded a full video on these guys in the weekend, so I'm not going to get too in-depth. Now, what I will say from the start in regards to these, they really excite me personally. The only publicly traded space play. They have a lot of news up and coming this year. They have quite a lot of hype on their side. The last month, they've moved up an awful lot. Pre-market, we're up a little bit again. Yesterday, we did see a little bit of a dip. We saw a 4.45% dip. But the 2 days before that, we went up nearly 30%. So it was a very small dip when you look at the bigger picture. These literally want to bring people to space. As far as stocks that are under $25 go, they're nearly always speculative. I mean, that's why the big, well-established companies aren't $25 a share. I love the look of this company. I really love the look of this company. More than any of these other plays today. And if you watch my full video on them, I've done 2 at this stage, I think. I'm going to be putting them into super amazing. I know, again, that's going to be controversial, but as far as a company goes, for less than $25 a share, Virgin Galactic have to be the pick of the bunch, in my opinion, right now. And then second up, we have Workhorse. Another company on the weekend I did a full video on, speaking about, you know, what could happen or the likelihood of them getting the USPS contract. This is a company with a $1.15 billion market cap, okay? On the monthly chart, it's up 175%. It was up 253%. If we go back a little bit further to the 6-month chart, when all this started to happen, up over 700%. If you know me, it's not like me to invest in a company that has gone up in that much value in such a short period of time. If you're not aware of what's going on, USPS essentially has a contract worth approximately $6.3 billion, and 4 companies are in the bidding process, and we're just waiting to see who won the bid. If Workhorse, a company with a market cap of 1.15 billion, even gets a percentage of that contract, if they get 50 to 75%, the stock price is going to go up. Simply put, it's going to go up a lot. If they don't, this is the beauty of it, I still think in the long term, they're an incredible company with incredible prospects who are offering services that companies are going to need as the world moves online. These guys, if you're not aware, are in last mile delivery trucks. So the truck that brings your package from Amazon from the post office to your house. They also have several patents on delivery drones. These guys could well be the future of delivery. So even if they don't get this USPS contract, there could be another contract down the line that they do get. But all in all, regardless, in the long term, I love the look of this company. Me personally, I'd love to put them as super amazing, but I am going to put them into amazing, because if we don't get the contract, which there is of course a possibility of happening, our money is going to be tied up for a considerable period of time. And not just that, if you've bought recently, we're going to be down a considerable amount for a considerable period of time. But this is what comes with these growth stocks that are, you know, very cheap, below $25 a share. There is always going to be some risk involved. Okay, now I'm going to try put everything in exact order. So obviously, Virgin Galactic's at the very top. Workhorse and amazing. Now, I would put up in front of those, I would put NIO there, go there, and then that is how quite good would look. Mid tier we actually have nothing in. Now again, EPD could potentially come down there, but I'll leave them up there. Meh. Right, if I had to buy one of these 4 companies, it'd look something like this: Carnival, Norwegian, MGM, then American Airlines, and then obviously Dave & Buster's is last place in the stay away category. There we have it, guys. I don't expect everybody to agree with me. It is actually quite tough when you sit down and try to rank these companies to do it fairly. Obviously our own bias is always going to come into play, but I do enjoy making these videos. They're a lot of fun to make, and it does make me really think about certain companies. And this was one that was requested heavily. I mean, cheap stocks, you know, $20, $25, whatever it is, because some people don't have access to fractional shares. But hopefully if you did watch until the end, I was able to give you at least some sort of value in today's video, and you did ultimately enjoy it. That's very important too. If you did watch until the end, you are a true legend. I appreciate you and your support so much. It genuinely does mean the world to me, so thank you. If you did enjoy and you haven't yet, please do drop me a like and drop me a comment down below. Let me know what you thought. Those 2 things help me out so much. I hope you all have an absolutely fantastic day. I will see you for tomorrow's video. Peace.